Welcome back to Marx's Dialectic of Money. In Part 1, we traced money's leaps from simple commodity exchange, CMC, to capital's endless self-expansion, MCM, full of contradictions and abstractions. We saw how money transforms from a simple medium into a self-valorizing force that dominates the physical world. Today in Part 2, how futures markets resolve production uncertainty, then dialectically leap into financial hedging, options premium harvesting, and finally the brutal last battle on expiration day. This fits perfectly as the climax of the dialectical evolution we are studying together. We'll cover open interest buildup, max pain gravity, and price pinning, the forces that turn expiry into a high-stakes war where big players push prices to maximize their edge. This is capitalism's financial machinery in action. From farmer hedging crops to institutions battling over abstract value on the final day of the week, we are moving from producer stability to financial protection, then to abstracted premium harvesting, and finally the chaotic expiration day battle, driven by open interest concentration, max pain gravity, and pinning pressure. This is a journey through the heart of the machine. Link to Part 1 in description. Let's dive in. Marx starts with commodities produced for exchange, but prices fluctuate wildly, a core contradiction in capitalist reproduction. Producers hesitate, invest in planting or mining if tomorrow's price crashes everything. This uncertainty threatens the very stability of the production circuit and the lives of those within it. Futures resolve this thesis-level problem. Producers short futures, sell forward at today's fixed price, get upfront security, deliver physical goods later, focus on real production, price risk hedged away. This creates a temporary resolution to the inherent volatility that naturally exists in the market. Consumers lock costs similarly, dialectical role. Futures as risk avoidance tools stabilize production circuits, boosting economy-wide confidence. But resolutions spawn new tensions. Abstraction begins. The commodity is no longer just the wheat, it is the promise of the wheat, a ghost of the future. Leap 1. Futures expand beyond commodities and directly into the heart of finance. Now, holders of assets like stocks, bonds, and inventories fear drops. Value alienation intensifies. They short futures against holdings. This isn't about moving goods anymore. It's about protecting the abstract value of capital. If spot falls, futures profits offset. Example, company with commodity stockpile shorts futures, crash covered. This flips the script from production stability to asset value protection. The focus shifts from the farm and the factory to the portfolio and the balance sheet. The real world begins to fade. Speculators add liquidity, enabling price discovery, but introducing detachment from real goods. Marx sees money advancing. Concrete hedging becomes abstract capital preservation. The link to the physical world of labor is getting thinner every day as value becomes increasingly ethereal and digital. Options upgrade flexibility. Trade rights, not obligations, focus on call selling by holders, covered calls. Problem, downside fear persists, but holders want income too. Sell calls against assets to pocket the premium up front. This is the synthesis, merging protection with revenue generation. Pocket premium up front. If price stays below strike at expiry, option expires worthless, premium cushions drop, rise, deliver from holdings. This is a new level of abstraction where money is made from the mere possibility of an event rather than the event itself. Value is harvested from the future. Theta decay favors sellers. Time erodes value. Hedging now generates revenue, drawing more players and exploiting volatility. Dialectical synthesis, production stability, plus financial shield, auction value from time itself. Time is literally being converted into money through the mechanism of the options contract. Final leap. Hedging detaches completely. Naked call selling for pure premium grabs. No assets needed. Institutions sell calls. Harvest theta decay. Low vol periods. High win rate. But the real drama unfolds near expiration. The last battle on expiry day, where the abstract math finally hits the real world. But the real drama unfolds near expiration. The last battle on expiry day. often Friday 4 p.m. close. Open interest, OI, total outstanding contracts per strike. High OI clusters signal massive positions. These are the target zones where the battle for the final price will be fought and won. Calls and puts buildup creates gravity wells. Market makers hedge delta and gamma aggressively around these levels to stay neutral, amplifying flows. The machinery of capital is at its peak speed, and the pressure on the price becomes almost physical as the clock ticks down to the final bell. Max pain. The strike where the most options, dollar value, expire worthless. Maximum pain for buyers, minimum payout for sellers. Calculated from OI. Sum in-the-money dollar losses per strike. The point of highest cumulative loss for the buyers is the magnetic north for the market on this day. Theory: prices gravitate here as expiry nears. Sellers, often institutions, benefit most. Highest cumulative loss point equals max pain. It's an invisible force, a gravitational pull that shifts billions of dollars in value in a matter of minutes. The winners and losers are decided by pure mathematical logic. Price pinning, the observable effect. Underlying price pins or clusters tightly around a high OI strike, often the max pain level in final hours or days. This is the visible scar of the war, where the price is effectively nailed to a strike price to ensure the maximum number of options expire worthless. Why? Delta hedging by market makers. Plus proprietary pushes create counterforces. Buy-sell pressure stabilizes price at the strike, letting options expire worthless. This is the peak of financial abstraction, where the price of a stock is determined entirely by the need to satisfy a derivative contract. This is the battle. Sellers defend the strike to nullify options and keep premiums. Buyers fight to break it. High OI plus max pain pull like gravity. Pinning is the visible evidence of this massive, abstract war. Marx would call it peak alienation. Value battles detached from labor decided in expiry moments. The physical world of the farmer and the real commodity is gone, replaced by the mathematical struggle of capital against capital. In these moments, the contradiction between use value and exchange value is at its most extreme. The system ignores reality to fulfill the internal logic of its own contracts. Futures and options dialectically evolve, from the producer hedge to the financial shield, through premium abstraction, and finally to the climax of the expiration battle. Each stage builds on the last, increasing the complexity and the stakes for everyone involved. The machine only grows more intricate. What do you think? Tool for efficiency or mechanism of exploitation? Your input helps us build this journey together. See you in the next episode for the derivatives crisis. Thank you for being part of this exploration into the hidden machinery of our modern financial world. Stay dialectical. Don't forget to check out the links in the description for Part 1 and other related materials. We've compiled a list of resources to help you dive deeper into these concepts. We'll be responding to the best comments in our next deep dive into financial history. See you there. Marx's work continues to offer a powerful lens for understanding the complexity of our modern world. Whether you agree with his conclusions or not, the dialectical method remains a vital tool for critical thinking and analysis in an increasingly abstract global economy. Next time in Part 3, we dive into the world of derivatives and global crises. We'll explore how these instruments can both mitigate risk and amplify catastrophe. It's a journey you won't want to miss. Make sure your notifications are on so you don't miss the launch. Until then, keep questioning everything and stay dialectical. The world is a complex place, but through critical analysis, we can begin to uncover the forces that shape our lives and our future. Thank you for watching, and we'll see you very soon for the next chapter. Follow us on social media for daily updates, behind-the-scenes content, and more. Our community is growing every day, and we'd love for you to be a part of it. Check the links in the description below to join our Discord and start the conversation today. This has been Part 2 of the Dialectic of Money series, a production focused on bringing complex economic theory to life. Thank you for your time, your attention, and your support. We will see you in Part 3. Goodbye for now.